Welcome to the Daily Update. This is being prepared Tuesday, February 22nd, where we'll look at the action in the market today and then see how things look for Wednesday, February 23rd. And the decline continues. We're right at the bottom of that short-term range that we've been in. We're still dealing with the potential of support in the area, but there are lots of negative things to look at. I'll try to point out both the negative and the positive things. But right now, with everything that's going on and with the real negative attitude that's in the markets, this might continue. We could see a bit of a bounce. It doesn't necessarily mean it's going to go down right away, but the mood from last week carried over into this week has switched more to negative. So we'll just have to see how things play out. As I just started recording this, the S&P futures trading overnight are up about 0.5%, but that's happened before. We've been up as much as 1% sometimes, only to have them fall back down and sometimes even go negative before the open. Over the 3-day weekend, futures were largely negative. We were down more than 1% in overnight trading. And before the open, we saw prices come back up. And even though we opened with a gap lower on Tuesday, the futures had recovered a great deal before the market opened. So we look at this, we try to get a gauge for what is happening. I follow lots of different markets and make them relevant to what is happening in the S&P 500. So let's recap what went over on Tuesday. The S&P futures had been strongly negative before the open. Even though the market was closed on Monday for President's Day, the S&P futures still traded. We still have Asian markets and European markets. They don't celebrate President's Day, so they were still open and the futures still trade. The idea is that the markets need to be open as much as possible because all known information can be fed into current prices. When we have these long gaps, when the markets are not open, that's when we can get huge swings from one point to the next. So I still watch them even over the weekend and as they start trading in Asia and Europe. But we did have a gap lower open, and I'll show you that in the chart. But we saw some buyers coming in. Things looked like they could be switching back to positive at the open. That's why we wait until the close to do things if you're a trend-based trader. But we went back up. We actually went positive for a little bit. Now, was that new long positions being initiated or short covering? Because they both have to buy to either get in or get out. Regardless, the gap was filled. As the day went on, selling just continued and it ensued below S2. And we went all the way down to the 42.70 level. But then we saw some real positive action. Buyers came back in and it looked like things were going to recover quite a bit. But right at going into the close, we saw some more late day selling. We ended up being down 1.01%. Volume was above average. And what we're looking at right now are that the technicals are negative. You look at pretty much any chart that I show, there are a few exceptions, but they're pretty much negative across the board. Some of them, though, are suggesting that maybe we've gone down a little bit too far too fast, which is kind of strange because we're at the lower end now of the short-term trading range that we've been in. So we really haven't gone anywhere that much when you look at it in the bigger picture. We still have earnings that are coming out, and then inflation is on everybody's mind, which also includes interest rates. And then the big geopolitical concerns, what's going on between Russia and Ukraine, what's going on in Canada. Those things are really not so much Canada. That's more longer term for the US markets and how things might change in the financial system and in a governmental situation or governmental just changes that could be taking place. But what we're seeing right now in Russia and Ukraine has a more short-term impact on prices. So what can we say about what happened on Tuesday? Prices are back down and they're at the bottom of that short-term range. We may break lower from here. We may be able to test this support that we're at right now and bounce higher. But right now, all indications suggest that the trend is down. And as I said, Russia, Ukraine, and Canada continue to dominate the news. We did have a report that came out, consumer confidence, which was weaker than expected. People are just not feeling good about what's happening right now. They don't like what's happening in the US. They don't like what they see happening around the world. And people are just not very happy about things. So they're less confident about where things are headed. We continue to be overvalued. We have to drop a lot from here just to get back to an expensive level based on past earnings. And then our trend, because we had a down day, our trend is strengthening and the bias and momentum both continue to be negative. So let's look through the day's session. This is something that I've been just kind of dismissing lately, because we're not showing an extreme reading. If we get all the way over to the left, that's extreme fear. All the way over to the right is extreme greed. Well, if we drop below this support, if we break this support, we have to look at this in a little bit different way, because that means there's more room to fall based on this index before people get really scared about things. And here's the longer term chart where we've been just chopping around. We have an up day, it goes up a little bit, a down day, down a little bit. Well, if we break through this support, this goes all the way down to 20 before we get into extreme fear territory. So taken as a whole, the way this index is calculated, there is more room to fall. Now, if on Wednesday we have an up day, this will probably tick back up and nothing will necessarily be decided, but we want to keep an eye on this anyway. Our VIX, yes, because we had a down day, it did increase from Friday, but this could also be taken as somewhat positive. Look at the bar chart. We closed near the bottom of the fear gauge when you look at the daily bar. So it increased, but we closed near the fear low on Tuesday. Half full, half empty. We're just kind of watching how the VIX is really playing out, because there's a lot of people that follow this. There's a lot of people that trade this. And so they're really paying attention to things. And this gives us some real insight as to what's happening. We also have the VIX of the VIX. It fell a little bit based on a closing basis. And even in the bar chart, it closed near the low. So, we're getting right near support. We're seeing on this chart, the VIX, we're seeing fear increase slightly, which is to be expected. But if we look a little bit inside the VIX, it's showing that fear is starting to subside. Could that provide some kind of a support, at least short term, for Wednesday? Of course it could. The futures are up right now. Fear seems to be decreasing. We're not in an extreme reading right now. But with all the geopolitical things going on, one wrong word out of Russia, Ukraine, or out of Washington, D.C., and the markets freak out. So this is just something to be aware of here. And then this is another indicator that I'm moving to another place. This is called the ulcer index. And I really only bring this chart up when we're having declines, because if you think of ulcer, worry, concern, fear, as the market goes down, this indicator will go up. And when we were falling after hitting the all-time high, the ulcer index, it went to a pretty extreme reading. And then as we went up to bouncing around, the ulcer index trailed off. Well, with the last 3 days now of negative action, the ulcer index is starting to climb, and it could go a little bit higher. And then just to show this to you in a longer term context, we got pretty high, excuse me, and I can't edit this out, I'm sorry. We got pretty high when we initially started to fall, but you can see the other times, especially after the COVID plunge, this is kind of an extreme reading. but this still could go higher. You could also say, we are seeing what potentially could be a positive divergence. If you look at price up here on the bar chart and you look at where we are right now, this is the support that I'm talking about. And we made a higher high with this Ulcer index than we're making right now. So price is at the same place, but fear seems to be a little bit less, according to this indicator. That could potentially be positive. As far as our sectors, every one of them declined on Tuesday, with discretionaries leading the way. Energy fell back a little bit. Utilities were down the least because they're more driven by interest rates. If interest rates go up these days, so do utilities and vice versa. Tech was kind of in about the middle as far as the percentage change, but it declined another 1.41%. I'm sorry, 1.4 points or 0.92%. Then looking at our sectors overall, and I always have to get these colors all straight. Discretionary is back into last place now, with the communication services in Chernobyl green. They're also pretty weak. You have tech, which is pink, and then real estate, which is also suffering, has been suffering lately, but energy still continues to be the strongest, even though it declined on Tuesday as a sector. As far as our inflation, we did see a bit of a tick up with the BDI, the Baltic Dry Index. As far as our Fed watch, just to review this, because we're seeing this played out in a pretty big way pretty quickly. This is what they were predicting, or the probabilities were, when the CPI was released a week and a half ago. There was almost a 95% chance that the Fed would raise interest rates 0.5 to 3/4 of a point at their meeting in March. Then we started to see a shift where we saw the 50 to 3/4 decline and the 1/4 to a 1/2 going up. This is where we are as of Tuesday, where they're even pricing in more of an odd that the Fed will raise interest rates 1/4 to 50 basis points, or 0.5%, while the 50 to 75 is decreasing. So like I keep saying in my videos, I usually only talk about this the day this is going to happen. Well, because things are shifting so much, I'm starting to talk about it a lot earlier than usual. And here's our historical chart. This blue line is where we're at now, and it's really decreasing in probability. But as we see the 1/4 to 0.5%, that really went up for a while, then it dropped back down. Now it's dropping back up, where the 0.5 to 0.75% move, it is trailing off now, where it had been in the lead just a week and a half ago. Our technical alerts are pretty much negative across the board. There was a point where the NASDAQ crossed above 13.6, and that was positive. Another positive, if you're into gold, is it went back above 1900. But the rest of these, Canada is having a lot of trouble right now with everything that's going on. The financial sector, the BPI crossed below 70. That's an official overbought signal now. And the NASDAQ was going up and down all around, 13.5, 13.4, 13.3. The Dow was below 34,000. Communication, it set a 52-week low. Communication also had a BPI that dropped below 50. That's more negative. If it's above 50, that's positive. Well, now we dropped below that. The S&P dropped below 4,300. Cyclicals, that is a bullish percent index, and it crossed below 30. Now it's into extreme negative territory, which might suggest in the future that there could be a bounce out of this area. Energy, the BPI crossed below 80. I already mentioned that. The industrials, they dropped below 30. So there's a lot of things, a lot of the value plays that we're seeing are getting to the point where they could bounce from here. It hasn't happened yet, and this can take some time to play out, but we're seeing some technical setups that could really help us see which direction the market will go into the future. Intraday, over on the right, this is where we had the gap lower. We tried to come in with some buying and actually went positive. But then, as we've been seeing a lot lately, any strength just brought the sellers in. We went all the way down to S1. We camped along here, and it looked like we were trying to build support, but then some more selling came in. We broke through down S2, and then we came all the way down to 42.70. But then, and this is better when it happens later in the day, we saw buyers coming in, and they really took prices quite a bit higher. And it looks like we were repairing a lot of the losses. Well, the last, half hour or so, things really trailed off, and we ended up closing not in the lower part of the mid-range for Tuesday. Here's what it looks like on a daily chart, where we're not really worried about the short-term resistance right now. We're far away from that, but we had a low set back in the fall. Well, we came down to that low and we're able to go back above it. We're now back down to that low again. In fact, we've actually gone a little bit under it on an intraday basis. But are we going to be able to find support and bounce up out of this? Or are we going to break through? Now, as I've been warning in some of my videos, if we do break below this on an intraday basis and you see the steam really start to get moving, don't be surprised, because there are probably hundreds of thousands, if not millions, of stop loss orders placed right under these levels. This is pretty important right now. And if price does move through that, this will trigger those orders, and that can make prices decline even further. Sometimes refer to that as gunning for stops, where some of the people that work on the exchanges, they see this, they know that all these orders are right here, and so they'll go in, wipe all of them out. Once they're cleared out, then they go back and take prices higher. So I'm not saying that always happens, but if you see things really pick up, if we drop below, that could be what's happening. We are now in correction territory. We, on a closing basis, we have declined 10.25% since the all-time high. So instead of this being a correction, just a normal, instead of this just being a pullback, we have now entered into correction land. And we'll have to see if are we going to go down 15%? Are we going to go down 20% from here? Are we going to bounce up from here? We might come out of correction land, but right now we are in it. Growth versus value, we're continuing to see an overall decline in growth and an increase in value. Then looking at the two indexes together, we have the growth index divided by the value index, and growth is losing, which means that value is winning. NASDAQ 100 versus the S&P 500, it was actually up a little bit on Tuesday, so not a real big change with this chart. As far as our trend, the ADX, because the red line is on top, it's picking that up and it's signaling that our trend is strengthening with the down day, and buying power is really falling. Then the mass index, a signal has now been generated. So we're waiting for something to happen, but we don't really know what that will be. You could make a case for either side. We could be getting ready to just tank from here and go lower, or something good might happen. The markets might see some positive things and we might be able to bounce up out of this. Then this is a new chart. I look at it every day, but this is the first time I'm talking about it in a video. This is called the Arun, and there's also an Arun oscillator, Arun light in darkness. It's some kind of meaning, and it's one of the Shand indicators. And how we look at this, it also helps us with the trend. That's why I have it in this section, where the red line is selling, the green line is buying. So when the green line is going up, that means that buying is going up and prices are going up. When the red line is going up, that means that selling is going up. This bottom line just measures the difference between the two. So if you take the red line and the green line, we are below this dotted line, which is negative, but it is advancing ever so slightly. Where we really pay attention to this is where the lines cross. So we hit our all-time high back in early January, and that's where this green part was. Well, we saw buying start to taper off, selling start to really increase, and boom, this is where we really started to run into trouble. And we've been declining in buying power, but a positive thing is we've also been declining in selling power. So what we're watching for is to see if the green line can cross above the red line. That would be positive, and if it can continue higher. And if it goes all the way up to 100, that means that buyers are in control. If the red line's at the top, that means sellers are in control. So I'm going to start including that, even though it requires a little bit deeper interpretation. This can help us sometimes. Our decision point scoreboard hasn't changed. The trend models based on the short and intermediate term are neutral, long term is up. PMO, negative, intermediate, and short term. Long term continues to be positive. As far as our breadth, we're negative. We had a down day. There was a lot more downward movement based on price and volume. So the blue line is continuing to fall, but still above the moving average, where this negative divergence that we've been seeing for a long time now, based on volume, yeah, it's starting to pick up some steam. The AD ratio is falling negative. It's below 0 and does have more room to fall. Now it could turn around and go the other way, but it's not giving us an extreme reading right now. New highs, new lows continues to trail off as we're seeing internal weakness in the S&P. The accumulation distribution, we're right at the moving average. We had a bit of a decline on Tuesday. What we're watching for is this to fall through the red line if that happens, and then eventually see the red line turn. Short-term indicators were way below the 20-period moving averages. Our moving average study, we're declining based on the 20, 50, and 200. Our moving average spaghetti tree, we're well below any of these, and we're starting to see these cross with a lot of other potential crosses happening. MACD is negative, and the histogram is going down, and these two lines continue to go down. The STO, which is still kind of baffling me. We've had 3 down days in a row, and this thing turned up. I don't know. This is a proprietary indicator made by Carl Swinland, and I'm sure that it's published somewhere. He knows some things about why it's calculating this way, but I'm not privy to that information, so I just follow what this chart says. McClellan oscillator is negative, and we're starting to get to extreme negative territory. Our shorter term indicators, the Stochn RSI is still pegged negative, as is the Williams percent art. Came up just a little bit on Tuesday, but it's still way down below -80. And the force index, this red going down, that's what's happening. That just means that we are negative right now. Intermediate term, we're well below the 50-period moving averages. They're not really in play right now as far as this chart. The PMO is negative overall. It's also negative based on price and volume. Our other PMO study, those PMOs that are rising, it's starting to get down to extreme negative territory. Those that are giving buy signals is decreasing, and those that are above 0, it's been floundering around, but with the down day, it declined slightly. BPI, we're starting to get more extreme now. It continues to fall. We're below 50, which is negative, and we saw a lot of point and figure sell signals generated on Tuesday. Our rainbow is not sure where the pot of gold is supposed to be here, but it's continuing to show some weakness. but longer term is still holding up. We could recover from where we're at right now. Some people could look at this and go, we're getting ready to break through to the downside. Other people might say, ooh, look at this, support, support, support. Boom, let's go higher. That could happen. Stochastics, short term, extreme and turning up. Intermediate term, still declining and going into extreme negative territory. Longer term is still declining with more room to run. Summation index is looking negative and getting a bit extreme based on price and volume. Again, you could do some kind of a comparison here. You could say that this is negative because when we were down at this level before, look at where the summation index was. We're back down to the same price, but the summation index is even lower now. That's a negative divergence, okay? You could almost make that case based on volume, but look at it, it's just at about the same place. I wouldn't call this a positive divergence, but it's not as negative as what we're seeing with price. But price is what's most important. Volume is nice to study. Volume tells us the intensity or how fast something is moving or the strength behind a move. But ultimately, we have to follow what price is doing. All of our oscillators, intermediate term, rolling over negative. Longer term, starting to show weakness, but are still positive. Short term are negative. Then the bottom fisher, the praying bottom fisher, it's finally starting to roll over a bit now. So, I mean, it could turn, and it's danced around a little bit before, but we're still kind of at that inflection point for, there was another inflection point up here, but now we're at another inflection point with this support that we're dealing with. If the market is going to bounce up out of this, it needs to get on the stick and do it. But if there's more uncertainty, if there's more fear, if there's all these war rumors flying around all over the place, people aren't going to come in and buy stocks with a vengeance. They need something really positive, will need to infiltrate the markets to get people to want to buy. Vortex continues to be negative with the green line declining and the red line going up. CCI is still in extreme negative territory. The rate of change, I haven't shown this chart in a while. We're starting to look more extreme negative right now. That might suggest there could be a bounce. Our different trading systems, the Elder system continues to be negative and the MACD continues to decline. The SAR continues to be negative with the dots above. Our different charts, Heiken Ashi is showing an even bigger black candle than before. That is negative. The KEGI drew a little bit more of a red down line here because it's picking up the support that we're really close to right now and previous support that we've hit. So this is pretty important. Renko added another red box after Tuesday. That's also negative. 3-line break continues to show dark black bars, so that is more negative. Equi volume still showing that we're right near some pretty important levels currently. There's other levels below this, but it just means that a lot more damage will be done before the market decides to bounce. The ease of movement on one day really didn't change, but over 14 days, it's showing that the path of least resistance is down. We had a new circle drawn on the point and figure chart, this red 0. It picked up the downward movement, but it's also showing that we are at or near support. Retracement, we had fallen through the 38.2. Now we're dangling around the 50%. We're currently right above it, but we could drop down below that. Long-term, our rhythmic scale, this is still part of the positive backdrop. We have dropped below the 200-day moving average. But until this gets farther away from that average and the line turns down, this is still more positive. And here's the logarithmic scale. Same prices, they're just plotted a little bit differently. We're just below the 200-day moving average. Special K, it is declining ever so slightly. Here's a longer term view of that same chart. Broad markets, here's the S&P, we're back down where we've been before. Mid caps, back down where we were before. Small caps, back down where we were before. FANG stocks, a lot of problem, but they closed well off the highs on Tuesday. They closed more in about the middle of the bar, but we have the death cross here, so the trend is negative, but at least you could try to get a little bit of positive out of this, but it's also dealing with support from previous sessions. ARK continues to have a lot of problems. It was down 2.18% on Tuesday. The Dow, it's also dealing with support. So we want to keep an eye on that as well. Small caps also continue to be down. There's some support back here, but not very much. It's just kind of bouncing around in its range. And mid caps, kind of the same thing, bouncing around inside the range. NASDAQ also looking more negative, not really as much support as what we're seeing in the S&P, but short term, we might be able to salvage some kind of a double bottom out of this. NASDAQ 100, it's starting to break below, and it's right down near the support that we dealt with not too long ago. Then the Vixen, it also closed near the low. That is interesting. Even though fear is rising, it declined as the day went on. That could be positive. NYSE continues to be back down in the range, but is showing weakness. The S&P 100 shows that the bigger stocks are continuing to underperform the smaller stocks in the S&P 500. Wilshire also back down to the range. Internationally, China's kind of going sideways to possibly turning down. Emerging markets, that's starting to roll over. Europe, it's looking a little more positive, but could be rolling over. Japan is sideways. The S&P, this had been positive, but the KST is starting to roll over. Looking at our all stocks index, we're back down to where we were before. Could this be a double bottom? Or are we just getting ready to fall even farther from here? Broad market, the dollar, it was down virtually unchanged. But it's still above 96 right now. It's actually holding up because the dollar will probably eventually disintegrate and not exist anymore with the advent of cryptos and all the other crazy things that are going on in the world. But for right now, it continues to hold up. And here's the start of a new weekly chart where it's in an overall uptrend longer term. Oil advanced on Tuesday. We're back up almost to 92. Gold, it's still seeing this bit of a breakout, but look at where we're at and look at where we were before. I will declare this a breakout, at least on a short to intermediate term, if we're able to break above 179. We're at 177.5 right now. Silver, it may have hit some overhead resistance. We went right up to the 200-day moving average. That was the high of the day, and we ended up closing at the low. Even though it was up 0.86% overall, this is a more negative looking bar. CRB was up 1.33% as we continued to see inflation become more and more of a factor. Bitcoin is having a bit of trouble. They're locking things down with the different cryptos in Canada. There's a lot of countries passing laws, and there's fear that things may happen in the future that would pretty much wipe out cryptos as we know them. There are a lot of pilot projects being implemented right now or tested out. And just think about it. I mean, as governments are so power hungry, the idea that something that is independent and transparent and can't really be accessed by the federal government. You don't think they're going to find a way to wedge themselves into it. They're trying to do it in other countries, and with things happening in the US, it will likely happen there. Now, it hasn't happened yet, but we're seeing a move in that direction. As far as bonds, here is our 2-year credit spread. It's continuing to fall. The other chart is not helping. We're looking at our Fibonacci retracement with the 10-year yield. We're right at about the 50% retracement. We're just under 2% right now. We saw a bit of a decline to sideways move with yields in the 30, 10, and 5 actually advanced. And the 2-year advanced quite a bit, and so did the 3-month. So we're still seeing a rise in interest rates. Then looking internationally, the US is still in the lead, and all of the major yields are now positive. Based on price, bonds continue to decline. Corporate bonds declined a little bit on Tuesday, and here's the current yield. It actually declined as well, down to about 3.29% if you were to purchase a corporate bond. Relative studies, we're looking closely at gold. This is gold compared to the S&P, where we're seeing gold really shoot up as the S&P continues to decline. So what do we look for on Wednesday? The S&P has entered correction territory. Now, that's not a big deal to me, but it's a big deal to the financial media. It's a big deal to some money managers. And it's something that the financial media can easily report to freak everybody out. So yeah, and that's defined as now, depending on how you calculate this, we might have already been in correction territory. But the way I calculate it, we have dropped below that 10% since the all-time high. The markets do remain in that short-term range, and the S&P now is at the bottom of that range. We still have earnings season that we're going through. There's still this battle between growth and value. On Wednesday, we have the weekly MBA mortgage application index that comes out every week. It's not a real big market mover. And then, of course, we have the geopolitical events, Russia, Ukraine. The Olympics have finished now, so I'm going to take this off the screen. Not hearing too much about the meetings in Vienna, and Canada just seems to be having some real issues right now. So our conclusion is the S&P is negative and range bound, but at the very lower part of that range, and it could break to the downside. The bias on both the short and intermediate term continue to be negative. The long-term bias remains positive as long as that red 200-day moving average is going up, but it is showing some weakness, and this advantage that we're seeing is fading. So if we see a lot more follow through with downward price movement, we're in danger of losing that long-term bias that is still slightly positive. So thank you very much for listening to this video. I hope you have a great day, and I will talk to you again after Wednesday's session.